Despite earning billions of dollars in earnings, it's common for huge companies to pay no US income taxes. In fact, despite making big profits and receiving $3.5 billion in total refunds, one review of corporate securities filings discovered that 55 of America's top corporations did not pay any income taxes in 2020. Can you believe that? For 3 years straight, over half of those businesses did not pay any US income levies. In 2020, the worldwide delivery company FedEx cancelled out $230 million in federal income duties on $1.2 billion in US pre-tax profits. Nike, a sneaker company, received a $109 million refund instead of paying any federal income duties on nearly $2.9 billion in US pre-tax profits. Dish Network, a cable TV company, received $2.5 billion in US income in 2020, but did not pay any federal income duties on it. Salesforce, a software corporation, didn't pay any federal income levies on $2.6 billion in US revenues. Looking at these figures, we're left wondering, how the hell do they do this? Taxation is an essential aspect of running a successful economy. It helps governments generate revenue to fund public services and infrastructure projects, maintain law and order, and provide social welfare programs. However, some of the world's largest corporations avoid paying their fair share of taxes by exploiting loopholes in the system. This video will discuss how big companies do this and the consequences of their actions. So let's dive in. However, before we proceed, it is important to give clear distinctions between tax avoidance and tax evasion. People often confuse tax avoidance with evasion. While both are ways to avoid having to pay the required monies, they are very different. Avoidance is very legal, while evasion is completely illegal. When persons underreport or fail to report income or revenue generated to a taxation body like the IRS, it is considered avoidance. If you don't record all of your income, including tips and incentives from your company, you are engaging in evasion. Evasion also includes claiming credits to which you are not legally entitled. Even if they have filed returns, some taxpayers engage in evasion by failing to file their returns or by failing to pay their levies. Evading this is a severe crime. Those who are held accountable may incur fines, prison time, or both. But is this really such a punishable offense? I mean, the companies are independent, right? Some of the most well-known companies in the US are able to avoid paying any federal corporate income duties because of the present tax laws. And then what? Well, the United States government loses billions of dollars in revenue as a result of firms paying no federal corporate income levies, even though it is completely legal and within the tax code's limitations. Moving earnings to nations with low taxes is one method big businesses use to avoid these situations. A seemingly wise move, don't you think? For instance, a business may establish a subsidiary in a country with low corporate tariff rates and transfer income earned in places with higher rates to that subsidiary. Using a technique called transfer pricing, businesses can claim that earnings were made in a low-income country in order to lower their tax obligations. Despite being legal, this technique has come under fire from the public and legislators for allowing firms to avoid paying their fair share. Amazon has been under fire for employing a number of evasive techniques, such as routing income via subsidiaries in nations with low tax rates and writing off expenditures for executive salary and stock options. Despite earning $11.2 billion in profit in 2019, the business paid no federal income taxes. Similarly, Starbucks was charged with exploiting transfer pricing to evade UK taxes. By overpaying for coffee beans, the corporation was able to transfer revenues to a Dutch subsidiary. Starbucks agreed to pay the UK government £20 million in overdue duties in 2015. Another way that large corporations avoid taxes is through the use of incentives and exemptions. Governments often provide incentives to encourage investment and job creation in certain industries or regions. However, some companies exploit these incentives by setting up subsidiaries or relocating operations to qualify for breaks. They may also lobby governments to introduce exemptions and loopholes that benefit their businesses, effectively reducing their liability. In order to lower their taxable income, big businesses also employ accounting strategies. Using accelerated depreciation is one such method, which enables businesses to write off larger depreciation costs in the initial years of an asset's life. Their income is decreased as a result, decreasing their burden. For instance, a business may purchase a manufacturing machine. The machine has a lifespan of 5 years, after which it loses value. They can deduct the cost of the equipment in the first year of investment from their income rather than spreading it out over 5 years. The 2017 Tax Cuts and Jobs Act created this clause, which permits businesses to immediately deduct all investment expenses. Companies were able to write off the full cost of these eligible investments in the year they were made from 2018 through 2022, according to the 2017 Tax Cuts and Jobs Act. Bonus depreciation will be eliminated in 2027, after falling to 80% in 2023, 60% in 2024, 40% in 2025, and 20% in 2026. Accelerated depreciation of equipment is expected to save businesses more than $130 billion in federal levies between 2020 and 2023, according to the Joint Committee on Taxation of Congress. One of the largest accounting scandals in history was Enron, an energy firm with headquarters in Houston. To conceal billions of dollars in debt and exaggerate earnings, the company's management established a sophisticated network of off-balance sheet businesses. Enron was able to avoid paying duties on its true income as a result. To lower their obligations, businesses can benefit from tax credits like the Research and Development Tax Credit. The consequences of large corporations avoiding taxation are significant. Governments rely on this revenue to fund public services and infrastructure projects, and when corporations avoid paying their fair share, it puts a strain on public finances. This can result in reduced funding for essential services such as healthcare, education, and social welfare programs. It can also lead to increased levies on individuals and small businesses who are less able to exploit loopholes. Furthermore, avoidance of these levies by large corporations undermines public trust in the system. When people see that some companies are not paying their fair share, it can lead to a sense of injustice and inequality. This can erode public support for the system and make it more difficult for governments to raise the revenue they need to fund public services. The goals of the US tax system are in contradiction. The goal of fairly maximizing federal tax revenues usually conflicts with a range of customized benefits pursuing various governmental objectives. Corporate lobbyists and tax attorneys will continue to be in demand as long as efforts to compel huge firms to pay their fair share must coexist with these credits and deductions, supporting a wide variety of favored activities. In conclusion, big companies avoid taxation by exploiting loopholes in the system, shifting profits to low-tax jurisdictions, using the incentives and exemptions attributed to this, and accounting techniques. The consequences of this practice are significant, including reduced funding for public services and infrastructure projects, increased taxes on individuals and small businesses, and a loss of public trust in the tax system. Governments need to take steps to close these loopholes and ensure that corporations pay their fair share of levies. This will help to ensure that the system remains fair, efficient, and sustainable for everyone. If you enjoyed this video, do not forget to like and subscribe to our channel so we can bring you more exciting topics like this. Until next time, do take care and stay safe.